Good afternoon, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SBFC, Standard Bank Financial Consultancy. My name is Ketio Gunene. I'm the coordinator, and we've got two presenters for you today, which will lead to the topic, which is how to manage investment volatility. But before I hand over to them and introduce you to the presenters, I just want to run through some housekeeping rules to make sure everybody's on board and understands how this system works. It's going to take about 45 to an hour, this presentation. So all you need to do is sit back, relax. First things first, you might want to check the volume of your computer or your laptop. Make sure it's at its highest point so you can hear everything clearly. What you do is on your taskbar at the bottom of your computer, you just increase the volume there. And then the second thing is I just want to make sure you can hear me on your side so that if anybody's got sound problems, you can try and attend to those. So what you need to do is on your computer, on the right-hand side of your screen, there's a small panel there. You've got a small high five. If you can click that for me, that will indicate that you can hear me and we can carry on. So I'll just wait for the majority of the high fives to come up. It's a small little hand. There you go. Victoria has found it. Wellington has found it. Yandi has found it. Thank you, ladies and gents. I see lots of hands coming up. Thank you, Richard. Thank you, Reina. Thank you, Norman, Nolene. All right. So I take it sound is good because all the hands are coming up. Second thing is questions. If you have any questions during the presentation, what you do is on that same panel where you just raised your high five, there's a questions box. You can type in your question during the presentation or at the end, and then our presenters at the end of their presentation will answer the questions. We don't want to take any questions during the presentation, which doesn't stop you from typing it, but we'll only address it at the end so that we don't disturb the flow of the presentation. Okay, so let me tell you about our pilots today who will be heading us through this flight. The first person that I'm going to tell you about is Mr. Errol Mayer, which you should know very well. Mr. Errol Mayer is a certified financial planner and an advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He's authored a book, Notes on Estates and Financial Plans, now prescribed for many universities. He's a renowned lecturer, examiner, and moderator for various universities in South Africa. He's previously worked as a legal advisor for corporates and as a tax advocate for SARS. He currently holds the position of Advisory Propositions Legal Specialist here at Standard Bank. He's going to take us through the first part of our presentation. Then when he's done, he's going to hand over to his co-pilot, equally qualified. His name is Mr. Malcolm Holmes. He's got a BCom Honors and a CFA, and he's the head of portfolio management. So he's got 23 years of industry experience. Malcolm started his career at Standard Bank in 1995, then transferred into the asset management division in 96. Based on the expertise gained in analyzing technology companies, he became a registered portfolio manager and launched the Standard Bank Science and Technology Fund in January of 1999 and the Standard Bank Global Technology Fund in October of 2000. Allied with this, within the SCMB Asset Management Portfolio Management team, he was responsible for managing traditional balance mandates for pension fund clients. And then in July 2002, he moved to Lordstone Investment, which was subsequently renamed Stanlib Multi-Manager. Currently, Malcolm manages the range of institutional portfolios for group clients and is a member of the Stanlib Multi-Manager Executive Committee. In his previous role at Stanlib Multi-Manager, he was Chief Investment Officer. Malcolm has been a key driver of SMM's success over the years and embodies the values of and culture in our SMM business. So those are our two pilots today who are going to be leading us. So I'm going to hand over to the first pilot, Mr. Errol Mayer, who will start us off, and then hand over to Malcolm. Good afternoon, Errol.
Thank you, Katiwe. And good day to all attendees. Now, in this webinar, you will hear about investment principles such as market volatility, diversification, building investment portfolios, etc. Now, we have all heard about diversification and reducing the investment risk for the investor. But is that enough to simply spread our investments around? And how should we diversify? Asset classes, currencies, etc. We also know that, for example, when interest rates rise, asset classes behave differently. How do we devise an investment portfolio that provides a reasonable certainty and amidst uncertain events such as future increase or decrease in interest rates? But most important, how do we devise an investment strategy to mimic my personal circumstances, saving goals, and investment objectives, given that these events occur at different stages of my life. For example, sending kids to varsity, my retirement, etc. We will hear that diversification is not only about spreading investments around to reduce the risk and average down returns, but operational diversification can manage down risk and manage up returns. But we must also guard against the unruly enemies lurking inside all of us. And what do I mean by that? Now, if you are also one of those many mortals roaming this earth who expect that the world operates to your expectations, to travel through life, always on the winning side, not tolerant to losses, while impatiently expecting all this to happen for you whilst you have no sound financial or investment strategy in place, then this is the webinar for you. If we can control virtues such as patience and discipline, it is important to have insight into these investment jargons and what it means for us. In our journey through life, we have many certain and uncertain events that will occur. We will deal with them differently. For the uncertain events, such as premature death or illness, we negate the risk to affect life insurance. In essence, life insurance is about distributing the risk of death amongst a vast group of people. Life insurance is necessary in a financial plan, and the purpose is to put you in a position where you should be had the risk not occur, and not to create wealth or serve as inheritance. But investing, on the other hand, focuses on the creation of wealth, looking into the future, and to put us in a better position as we continue with our journey through life. Now, both concepts of risk and wealth have a common denominator, namely time or term. If death, we do not have time, but if creating wealth, we have time. And as you will hear, time or term is especially important consideration when it comes to investing and financial planning. The concept of time is important since an investment strategy must correlate with the future lifestyle goal, and since the occurring of the event is certain, namely sending my child to varsity or retirement, we can plan so. The challenges are to reduce the volatility in investment portfolio, since volatility makes our job as financial planners very difficult. Volatility in an investment portfolio makes it difficult to plan for future lifestyle goals, since we need a certain pool of money when the event occurs. Let Malcolm take us behind the scenes how investment specialist helps clients and financial planners to select an investment strategy to reach a goal, given that lifestyle goals occur at distinct stages during your life. And then this is the role of the financial advisor, not to act as an investment specialist or timing the markets, but to help the client with the right investment strategy to ensure that the investor can realize his or her lifestyle goals. And now I hand you over to Malcolm. Malcolm, thank you very much.
Well, thank you all very much for attending the webinar, and thank you for that very kind introduction. I suppose the most important component of it is that having joined Standard Multi-Manager in 2002, we have been managing, I've been sort of helping clients, advising clients on how to deal with this problem of volatility and how to build solutions to, to solve for volatility. And it is a massive topic. Risk management, volatility, this is a very big subject. One could spend the rest of the day talking about it. But if you isolate it down to sort of volatility and managing volatility, it's important to understand the definition of the word. In terms of the dictionary, it'll talk to you about instability and unpredictability, which are two really, great words. And maybe it's important to sort of, understand the difference between volatility and, let's say, risk management. To me, volatility is a bit like driving a Formula One car. The faster you go in the pursuit of the reward of winning, the more likely you are to crash. Risk management is everything that we do to avoid the crash and to ensure that if a crash does happen, that the driver is safe and sound. And in financial terms, we do that by blending assets to reduce the volatility. And that is a very key component of risk management. In Formula One terms, it would be, having a great team, getting a great driver, having a solid process, having great tires, 4 great tires, and also sort of assessing the tires for the particular weather conditions. You could have, this set of tires for wet weather, this set of tires for hot weather. So that's risk management. It's about making sure that you build a team and a process that allows you to then manage the volatilities that markets provide. So it's important for you to understand as clients and investors these concepts and what it therefore means to us as portfolio managers. And hopefully today's session will give you some really good insight and useful insight into sort of that understanding. So to move on to the very first slide of the presentation, which is really an introduction in terms of what we're going to be covering. It's really about diversification and building well-diversified portfolios, and then we'll wrap up at the end with some long-term thinking. So let's talk about the introduction to market volatility. And this next slide is perhaps my favorite risk and return slide. Now, on close inspection of this slide, you'll notice that it's the monthly and annual returns for the JSE, going back from 95 to 2018. And you might say, but where's the risk component of the slide? Effectively, what the slide is showing you, that monthly, the green bars, it's very difficult to predict what will happen from month to month. One month it'll be up, next month it'll be down. And to be honest, nobody really invests for 1 month. So we can see that that is quite a volatile sort of outcome or prediction to say it'll be up next month or down. But you don't invest on that basis. So let's look at the rolling 12-month return, which is the red line. And that shows you the highs and lows that the market has provided on a rolling 1-year basis. And in very simple terms, just before the financial crisis in 2008, it looked like that red line got up to about 60%. So for that year to let's call it June 2008, before the financial crisis, the market was up 60% for 12 months. Now that's a very high outcome. Now, if you look at maybe 2010, looks as though it was down about 30% over the previous 12 months at that period, and that's quite a low outcome. And I suppose as financial advisors and investors, that's when one really starts to worry. The market's down, what should I do? And you start speaking to your financial advisor, and together you kind of almost forced into a decision. And really what the chart is trying to show you is that's almost the worst time to make a decision. So sometimes the best decision is to make no decision at all and just to leave it. We would say to ride out the volatility. Now, I want to show you that volatility over time actually kind of works itself out. It almost has no consequence, because if you look at the yellow line, that is now the rolling 3-year return for the market. And you can see very seldomly over any 3-year period does the market actually produce a negative return. Okay, and at times it's produced sort of returns of 30% per annum over a 3-year period, again just before the financial crisis. And what I want you to notice is that that line is far less volatile than the red line. In other words, over a 3-year period, the squiggliness, let's call it, of the line, the red line is very squiggly, but the yellow line is less squiggly. And in fact, if you look at the 5-year rolling returns, A, there's never been a negative return, and B, it's far less unstable or unpredictable. It's far less volatile. In other words, the longer that you stay in the market, okay, the less sort of volatility plays a role in returns. So important to understand, this is a chart of return. Over time, returns tend to be positive inside of the equity asset class. You do need to be patient, and you don't need to panic on a rolling 12-month basis when it's looking a little bit dire, because typically these things bounce back with the economy and with markets. Now, that's a great example of equities, and one could do this for any particular asset class. But first, maybe we should start with a high-level example of what risk and return means over the long term. And this next chart is a very simple theoretical chart that really just says, over the long term, the more risk that you take in your investment decisions, the higher return you should expect. It's a bit like going a little bit faster in your car. You should expect to get there quicker, but obviously it comes with risk. So you need to be rewarded for that risk over the long term. And as you can imagine, if you're not taking a lot of risk and you don't want to lose any money, you're going to be sitting in money market and cash on the left-hand side of this chart. But if you're prepared to invest for the long term and you're prepared to invest in equities and property and growth assets, then you'll be on the right-hand side of this chart. And over the longer term, you will benefit from taking that risk. And maybe just to illustrate the point, and I haven't chosen a particularly long period of time here, but I've chosen the last, in the last sort of 20 years or so, the 5-year return per annum for each of the different local asset classes. And really what I'm highlighting here is that the best 5-year return from each of these asset classes proves the point that if you take the risk over the long term, you should be rewarded. SA equities during that period of time gave you 36% per annum. Property, in fact, gave you nearly 42% per annum. South African bonds gave you about 21% per annum. And the best return that you would have got from cash over any 5-year period per annum was 10%, let's call it. Now, over the long term, by investing in these growth assets or higher performing assets, you're taking a risk, and time has shown that you have been rewarded for taking those risks. Different periods of time, you might find different outcomes, and obviously if you had to measure it to the bottom of the financial crisis when the markets were really bad, the numbers obviously wouldn't be as fantastic. But again, it's time in the market. Now, to make my point, I think what a lot of people forget about this theoretical chart is that in the short term, it looks completely the opposite. In fact, that's what it looks like in the short term. In the short term, what it's really implying is that in the pursuit of longer term, higher returns, there are going to be these short-term periods of time when the riskier asset classes can produce negative returns. Your money market and cash are probably still likely to produce positive returns during that period of time, given the nature of those asset classes. But your riskier assets, because of the volatility of those assets, because of the risk associated investing in those assets in short-term periods of time, can produce negative returns. And similar to my all-share chart, that's like looking at the red line, where over 12 months the returns can be quite bad, but then looking at the longer-term 60-month line, where the returns can be really, really good out of equities. And to put some numbers to this, I looked at the worst 1-year return per annum since 2000. So we looked at every monthly rolling period, and the 12 months combined, the worst return out of equities was 37%. So the point being is that if you're an investor and you can't stomach something that could go down 37%, then you shouldn't be investing in equity for 1 year. But as I made the point earlier, investing in growth assets, investing is about the long term, and in the long term you get those rewards for long-term investment. And this 1-year return of minus 37.6% would have been a component of a return that was encapsulated in that 5-year period. So property last year was down 25%. Bonds can go down. They were down 5.6%, the worst return over the last sort of 20 years or so. but cash was up, hence the nature of this particular chart. So the high-level summary, even though in the short term growth assets can go down in value, over the longer term they typically go up in value. And if you are investing for the long term, you will benefit from exposing yourself to those risk assets. And how do we as an industry deal with that in terms of building product? Well, the next slide is a very simple industry map of how one would go about building a range of risk profile portfolios for clients, ranging from all the way from conservative to aggressive. And you've probably guessed it, the amount of equity, the riskier asset classes, equity and property, global equity for that matter, in a portfolio determines its aggressiveness or defensiveness. It's more aggressive portfolios which are targeting higher returns, let's say inflation +6 over 7 years per annum, would have more equity in those portfolios. So the total equity content somewhere between 75 and 100% of equity. Whereas your more conservative portfolios would have less equity and more income or bonds or money market type assets, which come with less volatility in them. And as such, they target lower returns, inflation +2, but these returns are generally safer. And they for a shorter term period, as you can see. So to make the point that we made earlier, if you've got that longer term goal or that longer term investment horizon, then you can invest in the growth assets of equity, property, and global equity. Whereas if your goal is very short term and you really want to protect capital, you want to invest a bit more sort of expansionary than just in money market, you could invest in a more conservative portfolio like the Gold Defender. Now this is been put here deliberately. This is a range of products that Standard Multi-Manager managers for Standard Bank. It's the gold standard range of portfolios. And it's just a good reference slide to sort of understand how one goes about blending different assets to create different types of volatile portfolios or different types of risk return portfolios. Again, the higher the higher risk that you take, you should be rewarded with higher return. And over time, this is what I'd like to demonstrate to you is the case for the markets in these portfolios. So maybe just to sum up, sometimes the best course of action might be to take no action, certainly in short-term periods of time. Don't chop and change. Don't jump ship. Do early withdrawals at the bottom of markets when the conversation with you and your financial advisor is typically the loudest because you're the most worried and you're the most concerned. One should really just invest for the long term because volatility settles out to be of little consequence over the long term. And then when investing for the long term, invest in strategies that maximize return for a given level of volatility. And what I'm going to spend the rest of the time in this presentation on is really describing how we go about diversifying portfolios to reduce volatility without necessarily reducing the return down to that of the level of cash. In other words, by taking some risk over and above cash, how you will be rewarded in the longer term. So let's talk very briefly about diversification. There are many strategies to diversify away volatility. And I've kind of depicted this in the next slide where we're talking about those assets that have the greatest volatility. Clearly, investing in any single share potentially comes with the highest reward, but also comes with the highest level of volatility. You can invest in an equity index and that will reduce your volatility. And there are a whole bunch of other examples that I'm going to take you through here and actually demonstrate with live data how doing this type of diversification reduces the volatility of your portfolio. And then I'm going to really sum up at the end to show you how we as a business, as a financial services provider, we blend all these different types of assets into a portfolio or a range of portfolios that reduces the volatility to something that is acceptable to investors. So the next slide that I've taken off a system that we have back at the office is really just to show you the 20-day volatility of Anglos as a share. And going back to one of my first slides to point out that this is now volatility. It effectively takes the daily price series of Anglos and converts it mathematically into a volatility statistic. So what you can see on the left-hand side of the chart, during the great global financial crisis, Anglos was trading at a volatility of about 40, only to nearly triple all the way up to 120. So its volatility during that period increased significantly. So assets don't just have one level of volatility, but what you can do with a system like this is you can take the longer term period volatility, which is on the next slide, which is the 100-day volatility, which still depicts the same thing, but clearly you can see two things happening here. First of all, it doesn't reach the peaks and the troughs of the 20-day volatility, and second of all, it's a far smoother line. And we like to use the far smoother line because it allows us to fit more of these lines onto the chart. So this is Anglos. And to make my point about share diversification, if you throw into that chart Standard Bank, so Anglos, remember, is the green line. Standard Bank is the red line, and it's the volatility of the Standard Bank share price over a 100-day period. And I think it should be obvious to say that Standard Bank as a share is less volatile than Anglos as a share, and that may be intuitive to some of you, but to others it may not be at all. The reality is that Anglos is a global diversified mining play. It's a bit of a speculative type of proposition. It's got a higher beta, it's got macro influences. Standard Bank, on the other hand, is predominantly a local play. It's a very stable earnings producer. Its share is just less volatile for investors, and it's demonstrated on this chart. Now, the point being is that even though volatility can move in the same direction, share prices often move in the different direction. Anglos could be going up today because the rand is weakening, and Standard Bank can be going down today. And sometimes these shares work in different directions. And, you know, not only are there mining shares and bank shares, but there are also industrial shares or NASPAS or things that have completely different drivers to their return profile and their prices. And when you add them all together into an index, as per the next slide, you will see that the index has even less volatility than both Anglos or Billiton. Now, obviously, there are some shares on the individual capacity that could be very low volatility and other shares like Anglos that are very high. The combination of all of them in the weight of the shares in the index makes up the blue line, which is the all share index's 100-day volatility. But hopefully I'm making my point as you move from very speculative, high-risk individual shares to less speculative shares down to the index as a whole. You're reducing volatility. Now, I think a good point to make at this point is that this is the index. So this potentially could be equated to passive equity. And it might be interesting to try and understand or to try and demonstrate to you, what an active manager can do to a portfolio that can reduce its volatility. And then the next slide, the pink line, shows you a single manager in South Africa and their volatility of their price return. And to make the point, you can see, although less obviously so, that an active manager who doesn't just hold the shares in the weight of the index, he can upweight shares that he thinks are attractive, or he can downweight shares that he thinks are more volatile. And in doing that, he produces a return profile for investors that is lower volatility or lower risk. And that is to be seen by the fact that the pink line is below the blue line on average. And generally speaking, there are times when it is above. But mostly, active managers do reduce volatility or risk in portfolios by sort of actively selecting shares that they think will do better, maybe holding a little bit of cash in their portfolio for greater or better opportunities down the line, really just producing more defensive, more lower volatility outcomes. Now, it doesn't mean that they're necessarily going to produce lower returns, because the manager is obviously forward-looking and investing in a share or collection of shares that he thinks are going to do better than the index. And from time to time, he does better, and from time to time, he does worse. The point being is that this is part of his risk management process to reduce volatility or risk in his portfolio. Now, my next slide will illustrate the point that if you had to look at that in comparison to what a multi-manager does, somebody like ourselves, we blend portfolio, or we blend equity managers into a portfolio. And the simple process of blending those managers, where you might have 20% exposure to 5 different managers, each doing different things, each using their own processes and teams to navigate this equity world and produce returns for investors, the simple process of doing that diversifies portfolios even further than what any one active manager can do. Because just like a share, when one manager is going down, another manager could be going up in your portfolio. So in the simple example where you've got 5, if a manager is going down, we're lucky that we don't have 100% of that manager. And by construction and design, it's likely that another manager in our portfolio will be going up. And that process reduces volatility. And the next line obviously demonstrates the reduction in volatility. So that light blue line is now an equivalent multi-manager active equity fund in South Africa, where we've got 4 or 5 equity managers over time using actual history for all of these prices. And it demonstrates that not only is the multi-manager lower volatility than the index, the passive alternative, but also the equivalent single managed alternative, where clearly that single manager is managing 100% of the portfolio. We manage 100% of the multi-manager portfolio, but we've got 5 managers doing slightly different things, all invested in equity, but really, trying to use their process to select the best shares and avoid downside and all the rest of it. And it's that diversification that allows us to sort of demonstrate this lower volatility profile. So to summarize, the way that we deal with volatility or market volatility is to diversify as much as we can. Now, this is just an example of diversification in the local equity market, how you can diversify across shares, different sectors, different managers to get to a portfolio that is of low volatility. Now, the next slide that I want to show you is to really say that what happens if you increase global, for example, into a portfolio? Well, introducing global equity into a local-only equity portfolio also reduces volatility. And I'll explain that using the next chart. This is that same single manager active equity portfolio. It's 100-day volatility. So it really just demonstrates the volatility of the price series. If you add 25% equity, global equity exposure to that portfolio, you get the darker blue line. And clearly, over all periods of time, what you can see there is that adding global equity does reduce the volatility of a local-only equity portfolio. Now, the example that I'm using here is actually Stanlib's equity fund, where the pink line is Stanlib's SA equity fund only, and the blue line is their equivalent SA equity fund local only, but with 25% global. So they offer both of these to clients, and it's therefore very easy to generate a chart like this that demonstrates the lower volatility. But hopefully this makes my point around introducing global, because that's another great way of reducing volatility. Now you might say, but I would have thought global equities is very volatile, and what about the rand? And that should make it more volatile. The reality is that there are two components to reducing that results in this reduced volatility. The first is that sometimes global equity goes up and sometimes local equity goes down. And the pure simple act of that reduces volatility. But there's a more important point, and that is because global equities in a local equity portfolio are clearly priced in rands. It's a global equity portfolio which is in dollars, but in order to price it in rands, you've got to convert that global equity component back into rands. So what you're actually looking at is the introduction of global equities in rands. And the point about the rand, and this is an important one, is that when global equities are going up, it's generally as a result of positive sentiment, and it generally results in a risk-on environment. And typically when risk is on, okay, global equities are going up, and when risk is on, the currency is strengthening. In other words, if you had to compare it to the dollar, the rand is strengthening relative to the dollar. So the fact that you've got money offshore in the portfolio, actually when you convert it back into rands, creates a far more smooth profile than if you were just in dollars. Because global equities are going up, the rand relative to the dollar is actually coming down. It's i.e. it's strengthening, and those two offset each other a little bit, which actually reduces volatility. The same can be said of bonds or cash or whatever the case might be, global assets in general. So just to make the point that introducing global to local only portfolios does reduce the volatility simply because of that diversification. So I want to get back to our SA equity example and the impact of now adding different asset classes. Because as I highlighted earlier, equities is probably the most aggressive asset class in general and specifically in South Africa. Now, this is that same 100-day volatility chart of the all-share index. Now, what would you imagine that the volatility of the property index in South Africa looked like? Property's done very well. More recently, it's done very badly. And we can plot it. And the next slide does exactly that relative to the all-share index. And what you can clearly see here is up until about 2012, property was a lower volatility or lower risk asset class than equity. Now, there's an important thing to understand there is that volatility is a measure. If an asset class like cash produces a consistent 50 basis point return per month, let's just say it's positive and it's consistent, it'll have extremely low volatility. By the same token, if an asset class is going up by 1% per month and it's consistently doing that, it'll have low volatility. So you might all remember back to early after the financial crisis and back to 2012, property was a dream asset class. Produces lots of income, and it went up in this very steady, consistent fashion. And as a result, its volatility, as per this chart, was quite low. But the minute that you started to see it going up and then down and up and down, as it did in 2013, the volatility increases, and it increases quite quickly because the capital component of return started to move around a lot. And you'll remember 2013 was the taper tantrum, and it looked like emerging markets were going to have to raise interest rates dramatically because the Fed was now going to raise interest rates, and that increased the volatility of property dramatically. And it's pretty much remained like that since 2013. You'll remember 2015 was Nenegate, and there was a spike in volatility there. And then 2018, some of you might know Fortress and Resilient were two property shares that just really collapsed in a heap, and that created a lot of volatility. So that really speaks to property and its historic volatility. But what about bonds? Bonds on the next chart in orange shows you again it is on average a lot less volatile. So you can imagine that by adding bonds to an overall portfolio of equities, of global, of property, reduces volatility of a portfolio. Here's a great example. You can see Nenegate in the bond market. The bond market became very volatile around that time, and you can see the spike in volatility there. And my next asset class is cash, and you can hardly see it on the chart. It's that black line at the bottom, and it hardly moves. My point earlier around producing consistent, low risk, low volatility returns, this consistent sort of 50 basis points per month. So you can imagine that if you add cash into a portfolio of other securities and asset classes, it does reduce the volatility dramatically. So us as product providers realize that, and we introduce it into certainly the lower risk asset class, the lower risk risk profile portfolios. The problem with it is that you're not in the longer term going to win the race. So it's great to have as a short-term diversifier and a volatility reducing asset class. But we all know that if you want to beat inflation over the long term, you need to have exposure to some of these other asset classes that have over time, as per my earlier slides, demonstrated that they can do that. So hopefully that gives you a sort of a layman's introduction into how you can go about reducing volatility with all the instruments and asset classes that we as a financial services provider can give you exposure to. Now, I want to move to the next section of the presentation by very quickly talking to you about how we then build portfolios for your needs or for clients' needs. So how do we deal with this volatility? Well, this is the optimized asset allocation that we have for a range of portfolios I mentioned earlier that we manage for Standard Bank. All the way from your more conservative portfolios to those that have greater risk or growth asset exposure. So Accelerator has 60% exposure to South African equities, 10% to South African property, and 25% to global equity. So those are your more aggressive asset classes or growth asset classes, whereas Defender is really trying to protect capital because its mandate is a much shorter term mandate. And there it's got 52.5% cash or enhanced yield exposure, so very fixed interest-y. It does have some of the other asset classes because, as I've mentioned, those asset classes contribute to diversification. In fact, they will give us some of that upside if those asset classes in the longer term do perform. Now, I suppose the point being here is, we run a business, we run systems, we optimize asset allocations, and we've got to these different asset allocations for these different asset classes based on the mandates that we've been given. And over time, you'd be interested to know the volatility of these different asset allocations or these risk profiles. And you'd expect that Accelerator, the line is more volatile and it has a higher volatility than Defender, for example. And that is shown on the next slide. So what I've done is I've taken the strategic asset allocations which we built using those asset class blends and generated a price series using the indices for those different asset classes, and then put it into the same volatility system that I was using earlier. And I've gone back to 2011 to demonstrate the volatility of these different SAAs or strategic asset allocations for these different risk profiles. And clearly you can see in red here that Defender, the more conservative one, has lower volatility than the more aggressive one, and everything else in between. Accelerators at the top, and there it is in light blue, and you can see it's more aggressive than Advancer, more aggressive than Builder, more aggressive than Conserver, and more aggressive than Defender. Now that is important because in the short term, going back to the theme of my presentation, in the short term on the next slide, what I'm showing you is the return pattern now of those different SAAs. And clearly, this is just the return or the price of those different SAAs. Clearly, you can see in red that the most conservative portfolio rises and falls less sharply than any of the others, and in particular, to use my example, the most aggressive being Accelerator. So over time, they've all tended, and this is a very short-term period of time, they've all tended to produce the same type of return of, on the right-hand side there, the same point of around about 116, 118. But the point being is that investors in the red line, the Defender portfolio, would have got there with a far smoother return profile. To go back to my example of a Formula One racing car, it was great to have the Accelerator portfolio up until 2017 because it was the best performer at that point. You just don't know what's around the corner. And clearly, when markets fell early 2018, that portfolio and the others dropped far quicker in price than did the red line or the Defender portfolio. And as it rises, as it has done this year, very pleasingly, you can see that the light blue line has risen from about 104 to its 118. And that line is a steeper gradient than the rest of the line, indicating that it's had the best return because equities and property have driven returns during that period, and it has had the most exposure to those asset classes. So that is theory in practice. It's showing you that the more exposure you have to those assets in the short term that do very well, the better that you do. But in the short term, you are going to fall the fastest in those portfolios. Now, as I said, this is a very short-term chart. My real point that I want to make and really leave you with today is that if you look at the next chart, which is the longer term, and it's the same color coordination here, going all the way back now to 2011. Just remember, this chart that I was showing you previously started in 2016 when we launched those gold standard portfolios. The longer term chart starting in 2011 demonstrates the point that that portfolio, the Accelerator portfolio, with the highest exposure to growth assets, property, equity, and global equity, has done the best. It has risen the most out of all of those. Yes, you've got a positive return out of the red line, and it has protected you the most in the short term. And please note the 2011 data points, which show you the volatility of the blue lines compared to the red line. That red line just carried on up. But you haven't enjoyed the same return as you have, as if you were patient and invested in that portfolio that had the most exposure to the growth assets. Now, obviously, your goal may be a very short-term goal, in which case the red line is the best line or the portfolio for you. But if you do have those long-term objectives and long-term goals of growing your wealth, this slide really just demonstrates to you that you should have exposure to those growth assets. And if you can afford to, and if you can afford to be patient and just see through the short-term volatility, this slide really just demonstrates to you the need to be in the Accelerator types of portfolios. Have more growth assets. Remember, be diversified. Have lots of exposure to different assets. Have a multi-manager solution over a single manager solution potentially. Don't just invest in the index. Remember, this slide just is talking about the index. What we do from a risk management perspective in selecting managers for you is hopefully we're getting the best ones for you. In diversifying, we'll hopefully be reducing that risk and reducing the volatility without necessarily reducing your return. Remember, we're obviously as a business geared up to finding those great quality managers and putting them in the portfolios at the right time, and geared up for changing them if we need be. My final slide is really just to say, manager selection and tactical asset allocation can definitely help with risk management and in reducing volatility. And the way that a multi-manager goes about doing that is selecting and blending great managers into a portfolio. Our whole value proposition is to produce above average returns with below average risk. And we do that by selecting what we believe are the higher quality managers that can produce the better returns over long term. And just the diversification of 4 or 5 of them has been shown, as I've shown you today, to produce lower volatility or risk in a portfolio. And prudent tactical asset allocation can do the same thing. By being overweight equities at the right time and enjoying that return when they go up more than the other asset classes, or by being underweight equities at the right time when it is falling, can reduce volatility associated with the benchmark or the composite that SAA that I was showing you earlier. And I think the important thing for you as investors or advisors is that when this is done inside of a collective investment scheme, it's done without the tax impact of you potentially jumping ship out of one profile into another or one manager into another. Every time you do that, there's a tax event, a CGT event, and that reduces the return over the long term. So we try to encourage investors not to do that, to rather pick a profile that suits their goal, and in the longer term, therefore, your after-tax returns should be higher than trying to really sort of time the market and do this yourself. So thanks very much for your time today. I really just want to conclude with the 2 key themes, which is think long-term when you're investing. Have patience. Don't jump ship. Don't try and avoid having that conversation when the markets are at their lowest or are falling apart. Have a conversation, but try not to act then, because over the longer term, the best thing to do is just to have patience, because volatility has shown to have very little impact over the longer term. And then adhere to your goals, stick to your time horizons, especially in downturns. And this can really be a valuable discipline to investors and advisors over the longer term. So thanks again very much for your time.
Thank you, Malcolm. Katiwe, I'm going to help you here with the questions. We have a couple of minutes to take a couple of questions. Perhaps while you're looking at some of the questions, let me start with one that we have received. I'll read it out. It is Lebo from Rustenburg who says, I have been retrenched and would like to know what would be best for me to do with my pension fund. Then you say, number 1, should I pay off my current debt, which is my bond? And secondly, number 2, take my pension fund and put it in another pension fund scheme. Then she continues and gives some additional information and says, my husband has been paying the bond and we have turned our house into a guest house. And we were thinking that we can put the funds into the bond account so we can reduce our debt. Then we can start building up my pension fund when the business is up and running. Okay, so it's quite clear that you have some kind of plan. But the question is, where do I start? Now, first of all, you must realize at retrenchment, like retirement, it's one of those events where you have to explore options. And many of these options, there is a point of no return. So you better get the best advice when you exercise or you decide on a certain course of actions. So first of all, you do have certain options, but be more pragmatic. Where would I start? One is so keen to say, where will I get the best investment return? And that is not where you start. It starts with financial planning. It starts with your budget. So first, work out a budget and say, how much do I need? How much can I afford? And then, not only on the expenditure side, and what you have done so cleverly is looking at the income side. And I often tell people onto retirement, stop thinking only about the expenditure side, looking at skills on the income side. And you said that you were thinking of now having a guest house. So there's some relevance in that. Number 1, there's some practical considerations. And before I answer you, which is the best investment course that I think, is if you invest in a guest house, then all your interest expenditure would be tax deductible. And that's what we refer to as gearing. So the actual cost of paying the bond is a little bit different. So when you say paying off debt, I think you've got to distinguish between good debt and bad debt. Now, this one could be a good one. Opening up a business has its own challenges. You have to register for provincial tax. You do not make a mistake on that. Then taking your money and putting in your husband's name, there are certain anti-avoidance provisions which is not serious. So I think there's a lot more to be said than simply which is the best option to pay off my bond or put it in another pension fund scheme. So let me deal with two more aspects. Number one is, should I take my pension fund and put another pension fund? Well, deferral of tax. If you would take your money withdrawal, there's going to be a tax charge on it. But if you would put it into another retirement vehicle, doesn't have to be a pension fund, it could be a retirement annuity fund, it could be a preservation fund, and such instance you would transfer and there would be no tax implications and you defer it until a later stage. Here, speak to a financial advisor because there are different solutions. For instance, if you would have a preservation fund, you'll have the opportunity to make one withdrawal. Now, liquidity would be very, very important in your particular instance. And then one more thing, the fact that you're retrenched, bear in mind that you may have lost some risk cover and benefits, such as life cover and income protector. And speak to a financial planner that he can look holistically. And once you have looked at it holistically and explored all your options, chances are you will find the answers as to which is the best route to go. So I hope that makes sense. Then we have another question, and I choose to take this one secondly because it's very similar to the previous one, and that is a Mapaseka, who says, I have a lump sum of money from a previous company. Which is the best way to conduct research for investment options? I love it that you use the words options. And to do research, you do that with the help, and this is where financial planners come in, to assist you and to explore those options. But then you ask specifically, will it be advisable to join the new company's retirement fund, or should I opt for an individual plan? Very important one. So I'll quickly highlight what I said earlier. When you say the individual plan, do you mean a withdrawal and go and put it into some other investment, be it unit trust, endowment, etc., what the case may be, because there are tax consequences that you have to consider. Bear in mind, in the retirement fund, there are no taxes. There are no dividends tax, no income tax. There's no capital gains tax. And only when you take the proceeds, there may be a tax on the lump sum and some of the annuity, but you defer that to a later stage. So withdrawal is not a good option. So once again, liquidity could be an option. So a preservation fund may be a good solution to explore and to look into, because you're entitled to that one withdrawal. So I think what you are getting at, if you would transfer to the same pension fund, you have less options available because you can't make a withdrawal. If you would put it into another fund, then at least you have an option to have a withdrawal or liquidate at the later stage if you need be. And also perhaps a second retirement fund. Bear in mind that the retirement fund is not only for retirement. Retirement fund can be used for many other things. It could be used to cover for post-medical expenditure at a later stage. Those are the kind of pointers that I would suggest that you take into consideration when you discuss that with your financial advisor.
And then Malcolm, you've got a question there.
Yes, I've got a question on property. I'm interested in property investment. So due to high price instability and instability in the economy of South Africa, is it worth taking the risk to buy a property or to rent out now in this volatile economy? What are the advantages and disadvantages thereof? Well, a couple of interesting points. Property as an investment has been a very good investment over time. It produces a nice income, and over time does go up in price. But there's a house, and then there's a property share on the stock market. Houses are for living in, and certainly if one wanted to have a second home and rent it out, maybe now's a good time to get involved, because the economy is weak and typically it's therefore a buyer's market. But I don't want to be giving advice on that component of this. What I would like to probably mention is this word unstable economy of South Africa. It's a word that's often used, and one has to think about it a little bit in the context of, is it more unstable now than it was a year ago or 3 years ago or during the financial crisis, or not? Or is it just there is a level of instability or stability in any economy over time? economies move very slowly. And yeah, in the financial crisis, it could be more unstable. I don't think the South African economy is necessarily unstable at the moment. I do think it's just got a very low growth rate. And low growth rates, obviously not good for property investors or property investments, because higher growth rates tend to improve economic growth, which tends to improve corporate earnings, which tends to mean that corporates need office space, which tends to mean that corporates and property companies in the corporate space do a bit better because their vacancies come down. So the South African property market has been going through a very weak time at the moment. And so there could be advantages in terms of price by getting involved now. But I wouldn't do this, and I wouldn't get involved in doing this without a proper plan and a proper discussion with your financial advisor.
Okay.
While you're looking for the other ones, Errol and Malcolm, I'll answer the first two questions that came through as well from Gionel and Eric Magwaza about the presentation and the recording being available. Yes, we are recording this presentation. It will be available on the Standard Bank YouTube channel. It will be loaded by Monday. So if you'd like to see the presentation and hear this again, you can check that out on the Standard Bank YouTube channel. There will be a thank you note that will be sent out with the link for the YouTube channel.
Okay, Katiwe, let's wrap up. I think our time is running out. I say, how do I go about investing, obtaining more information, goal builder and advancer? We have, at the end of the presentation, there's a number that you can dial and you can find out more about that. And then we have a final question there. There's a one on tax, and that's from Eric. So Eric, I would suggest that you email me on that one because it is very specific as to the facts and some product houses that you're referring to, but feel free to contact me. But I can just tell you that moving from one fund to another fund, the retirement fund that's approved, there are no tax implications. There are specific deduction in the Income Tax Act for that. And that is then all from my side. Malcolm, thank you very much for joining us.
Thank you for your time.
Yes, thank you, gentlemen. And just last word, if you'd like to speak to a financial advisor or planner, please walk into any Standard Bank branch. We've got planners in all the branches. Or if you want an easier way, you just SMS the word guide. Just the word guide to 31791, and a financial planner or advisor will be in contact with you to help you with your queries, or email sbfccallcenter@standardbank.co.za. That's SBFC call center at standardbank.co.za, and the financial advisor will be in touch with you. Thank you so much, gentlemen. Very informative. I hope you have a great afternoon further. Thank you so much to our listeners. We hope you got as much as you could from that, and we'll see you on our next webinar, which will be next month, and we'll send you the invites closer to the time. Have a great afternoon further.